This is Satya Pradyuman of Cirrus Research. I want to call your latest attention to the Risk Metrics Report. This is a macro look at key markets around the world. We take a look at elements such as risk appetites. We've got crowding measures. We look at credit, and we look at a number of other measures, one market at a time. And in this particular report, the title, Risk Aversion Settling Across Key Developed Markets. However, crowded Indian equities trigger a more cautionary take. And in this particular pair chart here, what we flag is that if you look to the right, the risk appetites had collapsed really from January or so of 21. It's collapsed to some historic lows. And then in the last few months, it has begun to recover. In fact, both European data and the US data are starting to stabilize. This is by no means bullish in terms of what it's reading, but it's saying that we're no longer really in the depths of the sort of adverse posture view. Counter this to what we're seeing with the Chinese data is risk appetites continue to roll over. They're clearly not at the low rung that we've seen historically. So given all the geopolitical changes and the credit and the currency risks that are involved here, we do think that the discounting seen in Chinese equities warrant real skepticism when you look at other elements such as the credit markets, and I'll come to that in a second. Another key point to underscore is that we've really been harping at this idea that the profit cycle is peaking. It is peaking. This curve here starts to show how the markets have begun to really, top line growth has really begun to slow. And as a result, we do believe this quality call that we've been making, we've seen higher quality stocks outperform, but we think that this is likely to continue. In fact, if you look at the credit markets, given what the central banks are doing, given what the dollar is doing, what we'll notice also is that credit spreads in very developed markets have really started to climb quite a bit by a few hundred basis points. But notice the Chinese and Asia Pacific sort of emerging market high yield debt. Those spreads have started to climb way back to what we saw in the really scary real estate period of 2020. And so what this is saying is that caution is really, really a serious focus here for Asia, specifically the Chinese markets. And as a result, not only does it suggest that quality should work, but it does suggest that emerging markets will remain under pressure just because of the size of the Chinese equities in those benchmarks. Feel free to reach out with any questions. And as always, we'd love your feedback. Thank you.